Say you all are the smart ones here at the conference. This turnout's a little bit lighter than I was expecting. If you are of my generation, give or take, there was a saying, knowledge is power. And what we're going to hear today from Roisin is knowledge. I'm excited. I'm also kind of a data and numbers geek, and as she is as well. And so it is my pleasure to introduce Roisin McCord from the Federal Reserve Bank, Atlanta. She is here in the Birmingham branch. I've got a long list of accolades, but I think she's going to speak for herself when you hear her present. She's an economist. She picked up her BA from Notre Dame and her master's from University of Virginia. And let's just say, I have heard economists speak before, and some of them are pretty dry. Us number people can kind of be dry. She is not. So when she agreed to come here and speak at Sloss Tech, I was very, very excited. And what I'm hoping you all will learn from the data she is going to share is it is kind of a scary time these days. There's a lot of uncertainty in the world. We don't really know what tomorrow is going to hold, but we can look at the data and we can guess and have educated guesses at trends. We've heard the last couple of days about data and AI and what's coming in the future. And with Roisin, she's going to share her take on some numbers, on some trends. And for those that are here and stay to the end, because I have looked at the PowerPoint deck, there may be some discussion about where rates may be headed in the future. So like I said, I think you all are the smartest people here at Sloss Tech because you made time to listen to this. So with that, Roisin McCord.
Thank you, everyone. As Walt said, my name is Roisin McCord. I work for the Federal Reserve Bank of Atlanta, but I'm located here out of our Birmingham office. And what I do for the Fed is I work in our research department, and we have 8 times a year our president goes to Washington, D.C. to vote on monetary policy and to discuss decisions. And for that, he needs to have a really good understanding of the economy. So we have a lot of really brilliant economists in our research department who look at data, who look at trends. I'm a data person. My background's in economics. I think there's nothing like data to understand the economy. But the one issue with data is that by nature, it's backward looking. So it can tell us very well what happened last month, but it's not always as good at telling us what's going to happen next month or even what's happening today. So that's where my group comes in, and we go out in the community and we talk to businesses of all sizes, and we ask them, are you hiring? Are you planning on changing your prices? Are you planning on changing your wages? What are you seeing in the economy right now? And so we take that information back and we use it to sort of supplement the data and fill in some of those gaps that are missing. And we really believe that by pairing the two, the qualitative information and the data, we get a richer and more complete picture of the economy. And so I'm telling you all of this not to bore you with my life story, but to give you a sense of, as I'm talking about the economy today, where I'm coming from, and that's very much through that blend of the data and the qualitative information. But with the very, very important caveat, the most important thing I will say today, that any views or opinions expressed are my own and not necessarily those of the Federal Reserve Bank of Atlanta, the Federal Open Market Committee, or the Federal Reserve System. So, yes. So with that living out of the way, so I mentioned I work for the Atlanta Fed, but out of the Birmingham branch. So I know that sounds a little weird, but the Federal Reserve is what we call a decentralized central bank. And that's because we have a central governing board in DC, very cleverly called the Board of Governors. But we also have 12 independent reserve banks around the country, each overseeing their own district. And if you look at this map, you can see that the districts are clustered a bit to the eastern side of the country. This is because when the map was drawn in 1913, it was drawn to make a roughly equal number of banking assets in each district. Obviously, the economy has changed. If the map were drawn today, it would not look like this, but we have adapted within the same districts we have. Technology, as all of you know about, has helped with this. And also in some of our larger districts, we've created branch locations. So the Atlanta Fed has 5 branches outside of its main location. So the Atlanta Fed covers the 6th Federal Reserve District, 6F on your dollar bills. If you see that, you know they come from Atlanta. And that covers the states of Florida, Georgia, Alabama, and parts of Tennessee, Louisiana, and Mississippi. So basically the Southeast. So when we're out talking to businesses, we're talking generally to businesses headquartered in the Southeast, but they can be local businesses, they can be national businesses, they can be international businesses. And if we look at the Southeast economy, it's very representative industry-wise of the national economy. So as we look at national data and as we look at what we're hearing from the 6th district, we usually get a pretty good, they come together pretty well. So with all of that said, what's going on with the economy? Well, if I had a definitive answer, I think there would be a few more people in this room. But, but what we can say right now is that the economy is slowing from what it was, but it's still healthy. One of our directors recently said that it was slowing but not slow, and we really like that phrase. We think that's really much in line with what we're seeing in the data and what we're hearing on the ground. So these last few years, coming off of the pandemic, we had this crazy, unsustainable growth. GDP growth that was incredible, hearing firms say we cannot keep up with this pace of demand. Then a year or so ago, we started to see a little bit of a slowdown. Still very, very high growth, but not quite as high. And we referred to it generally as more of a normalization. So we're still in that phase of we have this very strong economy. We're still seeing growth, but the growth is not as fast as it was previously. That's what we're hearing, and that's what we're... Sorry, did you have a question? No. Oh, no, that's okay. Okay. Oh my goodness, did that get switched? I'm sorry about that. The data. But no, so I used to work for an economist right out of undergrad who always said that if someone wakes you up in the middle of the night and asks you what GDP growth is, you should just say 2%. So while that has yet to happen to me, my grown-up fear of the boogeyman has made me think about that so much that when I look at GDP, I always think, where is it compared to 2%? So the last few years, it's been way above that. Now, the most recent reading, actually yesterday it was revised. It came out at 1.4 for the first quarter. It's growth, but it's not strong growth, but it's coming off of a strong economy. Now, GDP is looking more at the production side, but if you look at more the consumption side, you're seeing the same thing. That growth has been really, really high. It's slowing, but it's not bad. However, the consumption side is a little bit better right now, a little bit stronger than the production side. We can see now, if you look at consumer growth in the last quarter, it was actually fairly strong, more so than GDP growth. And that's really in line with what we're hearing in that while businesses have pulled back a bit on investment, given the high interest rates, given uncertainty in the market, we're still seeing really strong spending on the consumer side. Maybe a little bit more price sensitivity, maybe they're shopping a little bit more for the bargains, but they're still out there and they're still spending. And that is one thing to keep the economy moving forward. However, we need to, as we look at this, there are some factors to consider. And one of these is the amount of excess savings that we've had in the economy for the last several years. So I don't know if any of you remember a few years ago, pandemic hit and we all went home. And we weren't able to go out and spend on restaurants and trips and all these things that we usually spend on. So we had money that we were saving. Government money was coming in. People were still making money, but they weren't spending it. And so the savings rate went way up. And as time has gone through, that's come down, but we've still had all these excess savings built up, and that's really fueled spending in the past few years. Things opened up, people could spend, and they had all this money that they didn't spend the last couple of years. Now, so we've been showing this chart for a while, and this chart shows here, the zero line here, the black line, shows where savings were across the country, consumer savings, heading into the pandemic. And the blue line is showing where they were compared to that over time. So up in August of 2021, when the pandemic hit, we saw savings growing and growing and growing. It got to over 2.1 trillion more than what it had been before the pandemic. Now, for the past couple of years, we've been saying, oh yeah, we've had these excess savings, but it's dwindling, we're coming down on this graph a bit. Now, the last 2 months, we've actually been below what we had before the pandemic in terms of excess savings. So that is one thing to really pay attention to, that if it has been this, which is a major factor, these excess savings that are spurring consumer spending, we've eaten through those right now. However, when we talk about relative to pre-pandemic, that was a really strong economy. I was working in economics at the time, and that's all anyone was talking about was how is the economy so strong right now. So reasons to be cautious as we're seeing this slowing, but at the same time, for right now, we are still seeing consumer resilience. Now, this differs depending on who you're looking at. The slowing that we do see is more pronounced in lower income consumers. And it's recently starting to spread a little bit to higher income consumers are still very resilient, but they're in some cases, shopping for those deals a little bit. But overall, we're hearing there aren't a lot of delinquencies, some upticks, but nothing huge. And people are saying we have reasons to be optimistic, even if spending does get pulled back. And I would say one of the most encouraging things in the economy, as far as the consumer goes, is the labor market. We have a very, very strong labor market, and this would not be an economic presentation if I didn't show you a graph of the unemployment rate. So here it is, job done. But the unemployment rate has been very low for a while. The most recent reading was 4%, which is extremely, extremely low by historical standards, and it's been below 4% for the past couple of years. So that means people are out there, they're looking for jobs, there are jobs for people to get. And this is, I don't know if any of you get as excited as we do every month when the jobs numbers come out, but it's like a holiday at the Fed, like really exciting. But for several months now, there have been a lot of jobs added every month, a lot. And that is a really good sign of a growing economy. However, if you drill down a little deeper into where these jobs are coming from, a lot of them are coming from government and from healthcare. And so government is a little bit outside the regular market conditions, right? Because those are government decisions. Healthcare, we've been seeing a lot of catch up in employment. So for a long time, healthcare was very understaffed. During the pandemic afterwards, I'm sure you all heard about the sort of travel nurse situation where a lot of hospitals couldn't hire nurses, so they were outsourcing to contractors. A lot of that has shifted now, and people are coming back into the workforce. Hospitals are able to hire directly. People are going back more directly into the healthcare business. And that is a big part of what is causing this growth in healthcare, which is a big chunk of growth in employment. So as we're seeing from that, as we see some catch up, maybe as they still have a ways to go to get to where they need to be, but there is a chance that that could plateau at some point. So while we're hearing there's growth, it might not be on a market level quite what we're seeing in the numbers. And I think that would fit very much more with what we're hearing from businesses. As we talk to them, we're hearing, yes, we're still hiring, but we're not hiring at a crazy rate. It obviously depends on the business, but most of them are saying, no, we're a little more stable now on the hiring side. For a long time, it was hard to get employees. Now we can get them. Now they're not leaving. There's not as much turnover, and we feel pretty good. So it will be interesting as we see this catch-up progress, how that looks. And I mentioned that it was very difficult to find workers for a while. When the pandemic hit, there was a huge drop in labor force participation. People weren't working or looking for work. And we have seen some recovery of that in the group prime age workers, 25 to 54 years old. They have really come back, and they have come back to participating in the labor force at an even higher level than before. We weren't sure that was going to happen, especially because women's labor force participation dropped so much during the pandemic, and we thought, maybe if there are 2 income households going to 1, maybe some of these women won't come back. that has not been the case. Women have come back very, very strong into the labor force, and a lot of that might be attributed to the more flexible remote work now that can be more accommodative to some families. I don't know that that's all of it, but we have seen prime-age workers come back. On the other hand, what we have not seen come back is the 55 and over workers. And that would be expected anyway because we have an aging population. So demographically, people are getting older. We would have expected more retirements. We would have expected less labor force participation in that group. But the pandemic really accelerated it. People retired early, and they have not come back. And we are expecting this trend to continue, fewer and fewer workers in that group. So that gives an idea that even though workers are coming back, even though we are seeing much better labor force participation, there's still some concern going forward. And then there's these 16 to 24-year-olds who haven't come back yet, and no one knows what's going on with them. So, in economics, we love to talk about labor, and we love to talk about supply and demand. So and we love charts. So I've combined all of these loves here. And this is a chart of the labor market shown through supply and demand. I'm getting very excited about it. But so the way we've defined supply of labor here is all the people who are out there working plus all the people who are looking for work. So basically the labor force. And the way we've defined demand for labor is all the jobs that are out there unfilled plus all the vacancies. So on a historical trend, this is recent years, but if you looked back historically, you would expect supply of labor to be above demand for labor. So you would expect there to be more people out there looking for work than there are jobs. That has not happened for a while, not for a few years at least. We have seen this big gap where there have been a lot more jobs out there than people looking for work. And of course, this is on aggregate. This is for the economy as a whole. It doesn't mean in every area, in every industry. But on whole, there have been a lot more jobs out there than people looking for jobs. And that gap has narrowed as more people have come back into the labor market. It's now a little bit under 2 million workers, where before it was over 5 million. So we're headed in the right direction. It's coming a little bit back more into balance, but there's still a big gap, and there's still overall we're lacking in workers in the labor force. Now, the interesting thing about this is, as we said, data is never perfect, and at the time when this gap was the biggest, when people were really not out there, when the labor force participation was very low, we were concerned that vacancies might be overestimated a bit. And this was for a couple of reasons. One, we were hearing from firms about what they called ghost postings. So they'd say, okay, we don't really have an opening right now, but we know it's going to be hard to find someone when we do. So we'll put out a generic opening, and then if someone comes along who's good, we'll snatch them up and find something for them to do. Another trend we were hearing was that firms were putting out multiple postings for one job. So maybe they had one job that could be done by people with a lot of different skill sets, but they wanted to make it really appealing and look really targeted to people with each of those skill sets. So they'd have one opening, but they'd put out 3 postings to make it look different. Now, those things have come back, have rolled back as more people have come into the labor force, as it's easier to hire. There aren't as many of those multiple postings now, or those ghost postings. So we're thinking that there's a little bit more accuracy in that. However, there's still that gap, and it's still very evident both in the data and talking to firms. Now, one thing this chart does not show is the average hours worked by employees. So we're talking here about people working and about jobs, but we're not talking about how many hours they're working every week. And if we were to look at that, average hours worked have gotten pulled back, have come down a lot recently. So as firms have been able to find more workers, they haven't needed to rely as much on overtime, and that's all a sign that the labor market is coming a little bit more into balance. And one of the most important signs, I would say, is if you all take a stroll down memory lane and think back to Econ 101, when demand is above supply, what happens to prices? They go up, right? And in the labor market, prices are wages, and that is indeed what we have seen for the past several years. So we have seen very, very high wage growth that has started to come down, still elevated wage growth, which makes sense as we still see this gap, but it's come down. And what we're hearing from firms is very much in line with this. You know, this data shows us up through now, still elevated. What we're hearing from firms is, yes, it's been elevated through last year. We expect this year to be much more normal, much more in line with historical trends. So we expect that wage growth to even come down a little bit more and settle. Now, that's what firms are looking at, but when you're a worker out there and you're thinking about your wages going up, it's not so much the number that your wages are going up as the amount that your spending power is going up, right? So you have to look at wage growth in relation to inflation. So for a couple of years, even though wages were going up really fast, inflation was going up a lot faster. So while people were getting paid more, they were still seeing a decrease in spending power. That switched in the past year or so, and now while we're still seeing elevated inflation and we're still seeing elevated wage growth is currently higher than inflation. So that's helping the American worker to catch up a bit and have a little bit more spending power. And so this leads very nicely into our next topic here. The Federal Reserve has a dual mandate of what we should aim to achieve, and that is maximum employment and stable prices. So if you are going to grade us on the past few years, I would prefer you grade us on the maximum employment part, but we're getting there, we're working. So inflation has been elevated, and in 2023, we saw a lot of progress on inflation, more than I think most people expected. It came down a lot. However, not down as much as we would like, and in the fourth quarter of 2023 and in early 2024, that progress has stalled a little bit, even ticked up a bit. Not to where it was, but it started to we haven't seen the same progress on inflation that we would like to see. Now, the most recent readings were very encouraging. They showed that it's starting to come down a little bit again. And also what we're hearing from firms is very, very encouraging. They're telling us, no, there was this little blip, but inflation is coming down. Our costs are not going up as fast, with the exception of insurance, which is a whole different story. That's going up. But overall, our costs aren't going up as fast. Pricing power, people and firms, customers in general, are pushing back on prices, so we're not able to raise them as much. And they're telling us very clearly, we think inflation is coming down. So that's something that we will look for in the data going forward. However, we hope to see more data, more encouraging data as we go along. Now, the Fed has a target for inflation of 2%, and that is our target for core PCE, which is one measure of inflation or preferred measure. There are lots of measures of inflation, CPI, PCE, core, non-core, headline, all sorts of things. That's what they choose, what they generally think is best for inflation trends. But I will stress that often people say, well, why do you rely on that? We look at that's what we use for our target, but we look at every type of inflation measure out there, cut it and slice it and dice it, and so that we have a really good sense of what's going on in general. Now, the inflation that we are still seeing, while inflation is still too high, that inflation is being pushed by the services sectors. So services account for about 2/3 of the economy. And when this inflation first started, it was really pushed by the goods sector. So again, remember, we all went home, we weren't going out and spending on services, but we all wanted that new desk chair, that new exercise bike, the new grill, and so demand went up for goods. At the same time, factories were closed, transportation was disrupted because people weren't going into work with the pandemic, so supply went down. So again, demand going up, supply going down, prices went up for goods. Eventually, things opened up, people went back to factories, people already had their desk chairs and their exercise bikes. That all evened out, and inflation has come down for goods. So inflation has settled on goods. We're okay there. But inflation has remained persistent in services. So that's where we really are wanting to see some improvement. And we've been seeing some improvement. We saw a bit of an uptick. We're hoping to see that improvement again. And I mentioned how we look at a lot of different measures of inflation. And one of the ways we like to look at it is if you think about how inflation is calculated, we're thinking about the cost of living in general. But so many things go into that. There's housing, and there's clothes, and there's transportation, and there's entertainment, and there are all these different things. So if one of those things that accounted for a really big part of our cost of living was going up a lot, that could make it look like prices were going up a lot in general when maybe it was just a blip in that one part of the market. So for that reason, we like to really look at all those different parts of our spending. So we look at housing, we look at clothes, we look at transportation, all those different things. And we say, of all those things, how many of them are seeing prices going up at above 3% and above 5%, which is high price growth. And so when we had this time of sustained inflation, we saw that it was very widespread, that it was up. The majority of prices were rising at that high rate. Then we started to see it come down, and that was really good because it made us think it's not just this one thing that's coming down. It means inflation in general is coming down in a widespread way. Again, end of last year, we started to see that tick up, and there were more prices that were going there, not as many as there were, but we were again starting to see several aspects that were going up in price. That's come down again. We're very optimistic about that. We're hoping that continues. I would say one thing that is accounting for a lot of inflation right now is housing, and that tends to be lagged in the data. So we're really hoping that if we get some good data on that soon, that might help a bit. But it's coming down, but it's not where we want it to be. And I know if you listen to our chair, he'll always say we need more confidence that inflation is coming down. This is one thing that could really give us more confidence if we see that it's coming down across the board. And I mentioned that at the Fed, we look at data, we go out and talk to businesses. We also have a survey center that surveys businesses every month, and we have a survey of business inflation expectations that asks a question each month about what firms expect their unit cost growth to be in the year ahead. And so this is a good way to look at forward-looking inflation expectations because firms have some insight into this, and it's going to affect their pricing power. So we can that way really look ahead at the next year. And it went up, it's come down. It's not down to 2%. And it's stalled a little bit in the past couple of months, but very much in line with inflation data. We're seeing the same thing, that it's starting to come down, just not quite where we wanted it to be. So that is a lot of information and a lot of different things going on. So overall, where are we in the economy? Well, what we're seeing right now, so we're seeing that the economy is healthy, but it's slowing but not slow. We're seeing that the labor market is still very strong. There are still a lot of jobs out there, but maybe not growing as fast as it was. And it's more people are coming back to work, and it's easier to hire. We're seeing that inflation has been very high and is coming down, but not coming down as quickly as we would like to see it come down. Then there are all these other political risks out there, geopolitical risks, high insurance, all these other factors out there. So looking at this, we say, okay, well, all of you can say, okay, what do I do for my businesses? What do I do for my finances? The Fed's in the same position saying, what do we do for monetary policy? So I don't know if any of you has anyone seen the dot plot before? One, yes, that's good. So the dot plot, what the dot plot shows, besides that the Fed knows how to rhyme, which we are so proud of, is it shows the projections of all of the members of the Federal Open Market Committee, who are the people who make monetary policy decisions, where they expect the interest rate to be at the end of the year, at the end of the next year, and in the long term. So this is from our most recent meeting. It comes out every other meeting. And the expectations there, the current Fed funds rate is between 5.25 and 5.5%. And so we saw some expectations for maybe 1 or 2 cuts in that, whereas earlier in the year we had seen expectations for more cuts. But then this whole thing with inflation happened where it wasn't coming down as fast as we had hoped. So that was adjusted. Long-term expectations are still the same pretty much for the interest rates, but it's just saying it might take us a little longer to get down. However, this is not set in stone. If I had shown you this in January, it would look different than it does today. And so we don't know what it's going to look like as time goes on. But that's why we rely so much on the data and also from the on-the-ground insights and talking to businesses and trying to keep on top of this. So I will give a shameless plug that if any of you have a business, and please, please, please come and talk to us, help us stay on top of this. You are the experts and you are the people we can learn from. And my email address is up here. You can grab me afterwards. And if the prospect of engaging conversation is not enough, then remember that if you don't talk to us, you are not allowed to complain about the interest rates. So thank you. And I'd be happy to take any questions.
Thank you. And we are going to take some questions, and can I have you then deliver the mic to those? And so this is a conversation piece. We have some time. Thank you. Give thought to questions because we have a great resource here and we want to answer those. So right there, that gentleman, please.
Yes.
Okay, cool. So in terms of the labor market, does it look like do those numbers reflect the gig economy? And if not, or if they do, is there kind of forecasting in terms of where the gig economy is going to go from an up or down perspective? I know those might be two separate questions, but I'm just asking.
Yeah, so gig economy is not my area of expertise. It's hard to calculate, so I don't think they're always in there because they're just so, hard to calculate in a lot of cases.
Yeah.
But so that's one thing where we're still trying to catch up on the measures. So
Thank you.
I'm not in.
I'll ask you a question while you all are thinking. Okay, right there.
Why is there still the Jones Act? Repeal one law and you get trillions added to the economy as quickly as humanly possible?
We don't comment. Luckily, we don't get to comment on anything policy-wise.
Can you repeat the question? What was his question?
Why is there the Jones Act? It's interstate commerce, any boat that goes between two U.S. ports has to be American-made, American crew, and American finance. There can't be small container ships that are foreign.
So the problem there is that's going to take an act of Congress, not policy from the Federal Reserve. So, right Congressman is all I can say. So the question I do have on that dot chart.
Yes.
On the dot chart, which I do love. So do the governors get around and like bet on where they're going to be at those to figure out which governors are right?
I don't know. So they talk. They have a 2-day meeting. They go and they bring all of the presidents bring the information they've collected from their districts. They look at data. They look at all these things, and they discuss over the course of 2 days. Where's the economy? What are the best decisions? And they're able to revise their votes up to the end. So there's often a lot of consensus because they've talked about it so much. But I don't know where everyone's particular vote is. So,
Okay.
yeah.
Any other questions?
Hi.
Hi.
Is this working?
Yes.
Okay, great. I'm a startup founder. My background is in computer science and product design, so
Yeah.
I don't know much about econ. But do you have any advice on when you think would be a good time to raise capital? I know this
That's a
might be
tough
out
one.
of your realm of expertise, but just curious based on where the market's headed.
I
you have
don't
any
on the
feelings
market
on that?
side. I mean, I think it's just always depending on what your situation is and what you see demand going forward as being. Obviously, interest rates are high right now, so if you're looking to borrow, you might want to wait. But if you have capital on hand, that can be very positive too. So,
Thanks.
And I would address that though. And for those who did not hear me speak yesterday, I'm the banker in the room. I'm Walt Polstwaite. I guess I should have introduced myself when we started. I'm the program manager for Lend AL through Innovate Alabama. But I would argue opportunity costs, right? We can all sit around and look at the interest rates, and if you do the math, 1%, 2% on debt, yeah, it's more expensive, but what are the opportunities that are lost if you decide, no, I'm going to wait 6 months to launch a business or a year to launch a business? So I would argue the best time to launch a business is when you have a business to launch. Let the other stuff shake out. Everything still has to pencil, but I think there's more to be lost in opportunity than in the interest rate.
Hey, so my wife works on a product that manages delinquent loans between large banks.
Yes.
And I keep seeing all of these charts that show them skyrocketing, which obviously is, good for her business, but not for, I'm assuming, the economy. Do you have any thoughts on that, or is that something you guys track?
Well, it's certainly something we track, and it's something that we're cautious about. We're hearing very mixed things and seeing very mixed things on terms of delinquencies, especially whether it's consumers or businesses. I think a lot of the concern in recent years, too, has been on debt being refinanced at higher interest rates coming up in the next couple of years. What we're generally hearing from banks is that they're working really closely with everyone who has that coming up, and they're trying to keep an eye on it and trying to work on ways through. They're hoping for interest rate cuts. It's uncertain right now, but it's something that they're doing their best, I guess. So.
And I'll comment on that as well. There are sheets in the back of the room that are talking about Lend AL. Innovate Alabama through SSBCI, we have 3 credit enhancements, so specifically to that, and you are correct. And that is why it's harder to get a loan today than 2 years ago. It has to do with non-performing assets at banks. Innovate Alabama through SSBCI now has 3 products that will help lenders say yes where they otherwise would say no. And refinancing is allowed with SSBCI 2.0, where it was not allowed with 1.0 a decade ago. So I would certainly grab some of that information. Check out our website. We have more information on there. But Alabama understands the environment for capital and the constraints on businesses accessing that. And that's why Innovate Alabama is changing the paradigm with these credit enhancements. So, and I did not pay him to ask that question, but it set it up great for the plug for Lend AL.
Hey, so we're at a tech conference, and I was wondering if you have any insights on the tech industry in particular. Anecdotally, over the past couple of years, we've seen lots of layoffs, lots of people having a lot of difficulty finding jobs. Do you have any data specifically around what's going on with tech industry as far as job growth, and do you have any insights or predictions for what the future might hold?
Yeah, so for a long time, as you said, it was hard to get people in tech, and then we started to see some of those bigger layoffs from bigger companies. And for smaller companies, it was actually like an opportunity because they were finally able to get the people that have been overhired by the bigger companies. We've seen some stabilization in that right now, I think, and I'm not an expert on that particular area, but I don't think we've seen as much noise there recently as we were for a while. So it's not like the first thing businesses are talking about anymore, which for a while they were talking about it a lot. So I think that says something. Sure.
Hi, thank you. Thank you for coming out in the presentation. So just a quick question, I guess. How important is like one person working, right, in our ecosystem, right, in throughout the course of their lifetime? How much is that? How impactful is that one person? How does that translate into the graphs, right? Because we're talking about like the combination or culmination of all of them, right? How much is that one person? But then, what does the loss of 500,000 working class Americans look like over 5 years?
Wow, that's deep.
The reason I'm probing those questions is that is the leading cause of accidental death in the U.S. is drug overdose, and we're losing over 100,000 people a year, over 100,000 a year. In the last 3 years, it's close to 330,000 Americans.
And most of them are in that working age band,
Yeah.
which
Yes.
is the highest participation.
Exactly. And I'm the founder of OD Revive, which is a overdose detection device and alert system that's going to hope to make a difference in that graph and in those numbers that you see that affects everyone.
People in the labor force, you mean?
Yeah, these are all working class Americans
Yes.
that I'm counting for.
Yes. So
Yeah.
the question is, what? I'm sorry.
Impact, right? Kind of like the impact of the individual, right? Because if you take all your graphs, they all boil down to a person, right?
They do.
And how much over the course of that person's lifetime did they pay taxes? And you're looking at trillions of dollars in lost tax money that goes to the government.
The economic impact of
The
one
economic-
employee.
Yes.
And then if you wind up losing 100,000 of these employees per year,
Yes.
what's the overall impact to GDP?
Gosh.
Translate
Just
for you.
thank you. I appreciate it because I don't speak that language.
It was easier when you were just being
language.
animated. So,
Yeah. I'm the animated guy. Yeah. So thank you for that.
no. So, I mean, I don't know in the exact numbers what effect it would have on GDP, but I mean, of course, for an individual person, that matters a lot. One thing that is frustrating at the Fed, but also as part of our role, is that we have monetary policy as a very blunt tool. So we can only do so much, and we really have to react to what's going on. Like, even as you talk about like policies or anything like that, we don't make those. We have to react to them, and we have to do what's best for the most people based on them. So that's really where we're coming from, is what's going on and how can we react to that. But I certainly understand for one person that makes a big difference, and the economy is made up of individual people, so that definitely accumulates. So
My 2 cents would be, you should reach out to one of the universities here in Alabama and ask that question, probably of a grad student, and let them really dig deep and write a thesis on that.
That's good. Yeah, that's a good idea. Cool. Yeah. If you could spare any change too, by the way, I'm just kidding. Thank you.
Any other questions as we're about to wrap up?
Why is it all the baby boomers' fault?
Oh, we got one in the back.
Hey, how you doing?
good. How are you?
Good, thank you. Really quickly, based off your purview, can you give us an overview of the national conversation or the national story as we talk about inflation on a state by state basis and a region by region basis? I know you're based in the Southeast, so what's that Northeast story when we talk about inflation? And in addition to that, 2 more questions. How does the U.S. compare to our global partners, i.e. the EU? And lastly, how far is the Federal Reserve from issuing its own digital currency?
Wow.
Those are 3 great questions.
Yes.
All right. Okay, we'll have another session. No.
No, so regionally, I can tell you in the Southeast, we've been seeing very similar trends to what we see across the country. And our data that we look at is all national data, generally. But what we're hearing from firms when we talk to them is very much in line with that. We've seen a little more resiliency in the Southeast economy in recent years, largely because of in-migration, but the trends have generally been the same. So I don't know if there's one region that sees more impacts of inflation, really, because I mean, it's a national, our economy is so national right now that it's hard to say. But I definitely would say inflation affects more the people in lower income groups who can't afford those increases in prices as quickly. On a national, as far as Northeast versus Southeast, I'm not sure as much.
And how is the U.S. comparing to the EU as far as inflation and consumer spending power?
Well, so we're doing pretty well actually right now. So the EU just did a interest rate cut, but they're seeing a little more softness in their economy than we are. So I don't want to jinx us, but we're slowing, but not slow, as we say. But it's these trends that have come off of the pandemic, of the inflation, and those have really happened around the world. But we're feeling good that we're cautious, but patient and watching right now.
Excellent. And are you able to comment on digital currency coming from Federal Reserve?
So I do not know if or when that would happen. I can tell you a lot of people are researching it, both in the bank, outside the bank. So you can certainly read up on it, but they haven't consulted me about when to pull the trigger on that or if to.
Roisin, thank you. We are out of time. Let's say thank you very much to Roisin McCord.
Thank you.
And enjoy the rest of the programming today. Here in this loft, Innovate Alabama will be having office hours for the Lend AL and Invest AL programs. If you were not in this room yesterday to hear about them, these are tools that Alabama now has with taxpayer money, our money, to help get capital into the hands of small business owners in the state of Alabama. Thank you for attending this session.